Do we have the technology that we need for removing CO2 as is necessary now for arresting climate change? Do we have it? And let's see what each of us say. Yes.
Please.
Okay, so my expertise is
Your name first.
Alana Lipchak. I'm a director in the capital markets group at Bank of America Securities. I cover, you mentioned mortgage-backed securities, so that is one of my areas of coverage along with asset-backed securities. So bonds that are collateralized by mortgages and other assets like auto loans, credit cards, student loans on the consumer side. You can do commercial securitizations as well. We have solar securitizations. It runs the gamut, really. But maybe I'll just give some high-level perspective on capital markets. And you talked a lot about greed, so I think I can give that perspective here. I would say with respect to ESG and how capital markets view ESG currently in the United States, because it's very regional specific. Things are different in Europe than they are in Asia than in the US. But in US capital markets, I think there is a frustration from market participants around the lack of usable, relevant, and standardized environmental, social, and governance data. And when we talk to investors, they have concerns around greenwashing. So when a company says they're issuing a green security, for example, and it doesn't actually turn out to be green, we call that greenwashing. And then most importantly, I think, is the difficulty for investors to translate ESG or impact investing into improved financial return. So if you look at the equity market, S&P was up 20+% last year, but if you look at the renewable components of that, it was actually down on the year. So I think greed is good in terms of directing capital, and unfortunately over the last year or two, there's been some stumbling blocks when it comes to investment in environmental and social causes. I would say higher interest rates make it more expensive for companies to invest in green financing. And it's just been very volatile over the last couple of years, and unfortunately, ESG has also entered the political discourse. There seems to be a headline every other day on ESG, whether it's coming from Republicans or Democrats. There's been legislation enacted at the state level that limits investors from using environmental, social, or governance factors in the investment process. Whereas in other states, such as California, they require it. Colorado also has a similar law, so it's becoming more and more bifurcated. But I think in any event, the Biden administration's current focus on climate and social issues, along with increased regulatory oversight, and from an investor's perspective, using ESG as a risk management tool is important. And so I think there's more to come there. In terms of climate risk specifically, I know that's kind of the focus of this panel. The rising incidence of natural disasters related to climate change poses financial risk to real estate and other hard assets. So from my perspective, covering the mortgage-backed securities market, and just for some context on how large that market really is, there's currently $10 trillion worth of mortgage-backed securities out. $10 trillion worth of mortgage-backed securities outstanding that are collateralized by agency mortgages, so has an implicit or explicit guarantee from the federal government. And then $3 trillion of non-agency mortgage-backed securities, asset-backed securities, and commercial mortgage-backed securities. So overall, about $13 trillion worth of investments out there. And one of the main questions around climate change that I get from our investor base, so I mainly work with institutional investors, so think asset managers, pension funds, and insurance companies. There is a rising concern around climate change and the impact of hurricanes and wildfires and what that can do to real estate valuations. And so an issue that we've come into the hurdle that I was talking about around data is how do we overlay climate risk data to geospatially where mortgages are located and where they sit in the mortgage-backed security market. So we've actually used government data, the FEMA National Risk Index, which is a public database produced by FEMA in conjunction with private and other public academic partnerships that looks at the US communities that are most at risk for 18 different natural hazards. And we've overlaid that data to the mortgage-backed security market so we can give our investors a little bit more clarity on which specific securities have higher risk of taking losses due to climate change. And just a note on the rising incidence of natural disasters is that NOAA shows that the amount of billion-dollar natural disasters events have increased dramatically in recent years. So they have a database going back to 1980. On average, you have about $8 billion events per year, so that means any event where there's more than $1 billion worth of damage. But in the last 5 years, it's been about 20 per year, and since 1980, there's been like almost $400 billion natural disaster events for $2.7 trillion worth of damage. One other thing I would note, and maybe Lori might speak to this a little bit later, is that there's also issues with dislocation in the property insurance market and being able to protect the value of real estate for homeowners. So I think insurance companies at this point are having some difficulty in modeling climate risk, especially in high risk areas like Florida and California. In some cases, they are pulling out of these states. There's several national insurers that have pulled out of California because they cannot raise premiums enough to cover wildfire risk. And from the investor perspective, if homeowners can't get insurance, it can damage or put downward pressure on the valuations of real estate in those communities. So that's really like the intersection that I'm looking at it from. But there are also pockets where investors are interested in financing newer technologies, asset-backed securities, again, that fund solar panel installations on people's roofs. So if you want to install a PV system on your house and you don't want to pay for it outright, it costs $20,000, $30,000, you can take a loan out, and those loans eventually get securitized and sold to end investors. We also see green auto securitizations that are backed by hybrid and electric vehicles, so just to name a few. I'll leave it there for now and then maybe pass it along to my fellow panelists.
Oh, thank you, Ellen. So I feel like I'm in Professor Chichlinski's class, right? So sorry. So in the interest of continuity, I'm going to touch on 5 things. So who am I? So my name is Shiva Rajgopal, and I'm an accounting professor. What do? I do many things, but in this area, I spend my time worrying about reporting and measurement and disclosure of ESG in general, a little bit about climate. So I just want to make maybe 5 quick points and see how people react. So the first point I want to make in the continuing what Elena was referring to, I think ESG as an idea is fantastic, but the implementation is a disaster, right? So I'll tell you why I think ESG is fantastic. And again, since I'm an accounting professor, I'm going to use financial statements as my anchor to make some of these arguments. So the first point is that we set the cost of natural capital in our financial statements to 0. What does that mean? If you give somebody mining rights, or if Coca-Cola is using water, you won't usually see a charge for water or whatever. I don't know how to value natural capital, but I know the value is not 0. So that's proposition number 1. Proposition number 2, our reporting system also does a terrible job of measuring externalities, right? Many of you are econ students, you know this. Both negative and positive externalities, to be fair. The negative externalities gets a lot of attention, emissions, biodiversity. But let's not forget positive externalities. Pfizer made a small portion of the value they added to the world by giving us a vaccine, or BioNTech or whatever. So we don't capture that as well, which is relevant to the whole ESG conversation. And the third point that doesn't get mentioned enough, I think, here is the plumbing of financial markets. So capitalism in general doesn't work well when the owner and the manager get disconnected. And I think increasingly that's happening because of passive investing. In fact, you could argue that ESG itself is a response to a broken model, and especially with respect to accountability. You know, why should Apple CEO listen to what I have to say? Because through my Vanguard fund, I own like 0.000% of Apple. So the idea that somehow, which kind of brings me to the second point, the carbon tax point, as the professor mentioned earlier, that this is not a hard problem to solve. The conceptual answer is a carbon tax. The politics is impossible, right? And you know this. So what are we trying to do? We're trying to create an as-if carbon tax regime in the private sector by naming and shaming people, by rating, you know, and in general, finance is not very good at imposing penalties on people because of externalities. It's perhaps good at creating incentives, the point made about green bonds and all the financing available, which of course also creates verifiability issues and so on, which we can discuss later if you like. But so the second big point is the whole system's been set up to create an as-if carbon tax, but without a carbon tax, this is generally not going to work. It's just difficult, right? Because people say all kinds of things. If you look at consumption patterns, it's very hard to change consumption patterns. I'll just give you an example. The world produces roughly 150, I think, billion units of new clothing a year. Just do the math, okay? 8 billion people, uniformly distributed. Each of us is consuming 20 new pieces of clothing. Why? Well, we have fast fashion, because there's no tax on this. Nobody is being asked to internalize the cost of doing these things. So that's the second point. The third point, will ESG make money? Elena's point is an excellent issue. There's a lot of hand-wringing, a lot of congressional hearings on this point. The best one can think about is maybe ESG is a way of thinking about risks that usually get ignored. Now, drawing a straight line from ESG into dollars is super hard. Now, if you want to push for something, I would say go for human capital in the S and maybe governance. In general, governance, there should be a huge payoff to governance. Nobody discusses governance when stock markets are up 20%. Is Tesla a well-governed company? Well, you can decide. Of course, it's fallen 20-odd% because they're not able to sell cars, not because of governance. So the idea of whether ESG can make money, it's like as you said, give me your name and I'll get back to you. That's a big issue. Two other points and I'll stop. The NOAA point, the billions of dollars that NOAA. So there are at least a couple of people in my class, and we went through this experiment. We picked one hurricane, Hurricane Ida, looked at NOAA's budget, estimates, $70 billion. And the assignment to the class was, go tell me on whose books are these losses. And we had an incredibly hard time finding that number. So we looked at all kinds of insurance companies, statements, looked at reinsurance, how much did they actually pay, the property casualty people, how much does FEMA pay. We could barely recreate about maybe half the losses with a lot of difficulty. So where are these losses? I guess they're uninsured, or they're opportunity losses, or what? So you need transparency from the government institution to even tell us how are you getting these numbers. And I'm not disputing that there's climate change and so on. I'm just asking for, just give me the data. Because without the data, without trust, you can't have markets. And the last point about insurance. People have pulled out of California and so on because of bureaucracy. I'm not denying that. But the one idea that sometimes we overlook is that the property casualty market is very different from the life insurance market. When a company writes a life insurance policy, whether they like it or not, they have to do something to assess whether we'll be alive for the next 15, 20, 30 years as a portfolio.
I don't understand.
I'm getting to it, wait. So the issue with the PNC market is that they write one-year contracts. They're writing a one-year contract on flood, on fire, and if you write a one-year contract, you don't need to manage risk. You're basically a cost-plus institution. You take the losses, you socialize that over the rate base, you add a premium, and you move on. Till the point where it becomes too difficult, too expensive for the consumer, and then you leave. And of course, you can always blame the bureaucracy and so on. But I think fundamentally, the structure of the PNC market, which is property and casualty, very different from life insurance. Hence, there is virtually no need to worry about the long term. So if you go and look at some of the sustainability statements of these insurance companies in the US, you'll find nothing. They'll proudly talk about a golf tournament that they sponsored before they talk about anything they did about some of the things that Elena was mentioning. So if I'll stop there, but the big point, you had a question on technology. I think we need a lot of reporting technology. We need verifiability technology before we can really make progress. So I'll stop there. Thank you.
Your name and then the title of what you want to talk about.
Okay, thank you. So my name's Laurie Schumann, and I'm speaking not on behalf of the Biden administration today. I'm speaking as a professional that's been working in the climate risk space for about 20 years, specifically with regard to affordable housing. So I just want to disclaim my comments today. I don't want to read in the newspapers tomorrow that someone from the Biden administration said this. I'm sure you, well, okay. So, first of all, it's so great to be in a room full of students that are just starting off on, joining us on this journey to really help to adapt our world to a changing set of risks. And I think that one of the great aspects of ESG is it's a great risk management tool. It's really, and you'd said, it's a manifestation of a failed system. I mean, in part, but I would also say it's also a manifestation of a global system, a system that is globalized to the point where, you don't have control over potentially the products that you're developing in Pakistan or Bangladesh or across the world from you, and yet you're promising consumers, a product. And so it's an indication of a globalized environment, and scope 1, 2, and 3 is really a question of really influence. And, as ESG evolves in this country, many of us keep saying it is a risk mitigant, and that is really important. Just a quick scan of the room. How many of you are in the finance or business school? Planning, architecture, anthropology, sociology? Okay. This work is really interdisciplinary. This work requires a multi and interdisciplinary set of capabilities to do this work. I'm a planner by trade. I entered into this work as a practitioner on the ground, working in many communities across the nation to help deal with issues of environmental injustice, issues of equity, issues of low housing supply. And I've done a lot of different things in my career. I've worn many hats. I've been a construction manager. I've been a policymaker. I've been an elected official. And so I bring those forward to this space, which is really important. Because right now we are facing the challenge of our lifetime. For many of us, the material risk that climate change presents to us is an existential one. And as the professor said so beautifully before, we need to think on a meta level to deal with this meta problem. This is not a small problem, and there's going to be many solutions. There's the mitigation piece, so I'm going to just briefly talk about the other side of the coin, which is adaptation to this changing condition, which is a complement to the mitigation space. We're going to talk about that, and just a little bit about the solutions I think that we need to be thinking about in the next 3 or 4 minutes. So there's really two sides of this coin when we talk about climate risk. So this is a panel on ESG, and ESG really asks us to look at upwards of 45 material risks when we assess our ESG space. Many of those material risks look at environmental, social, governance. Has anyone done a materiality assessment? Okay, we have one person in the room. And so, when you get under the hood, climate risk is one of the 43 or so material topics. More and more folks are saying climate risk is one of the most material topics that presents itself in the ESG space. And so I'm going to dig into climate risk. And climate risk really has two phases, climate management of climate risk. The one phase is how do we reduce the cause of climate change, which gets at the mitigation of emissions piece. It gets at reducing climate change by reducing global warming, by reducing greenhouse gas emissions. And if we have a hope of surviving, we have to reduce climate change. That's true. The other side of this coin, which I hope will be getting more and more equity, is the adaptation space. How are we adapting to our changing conditions? So my role at the White House is to really advise on climate adaptation and climate resilience. This is really known as the consequences of climate change. So the cause and consequences equation is really important for you all to understand when you try to assess the solutions. And so the solutions I look at very closely are in the adaptation and resilience space. Because many communities around the nation and around the world are seeing the effects of climate change in front of them right now. San Diego just experienced a torrential flood 3 days ago. It's a 1,000-year flood. You have every 3 days another climate event showing up to the federal government. And Ilana so beautifully said, each of these disasters is costing us $1 billion. In 2023 alone, believe it or not, we had $96 billion worth of disasters. Yet at the same time, we're not investing the amount of funding we need to in mitigating those explicit risks. So we have a much smaller pool of funding and investment in the avoided loss or the pre-disaster experience. There's a mismatch. And when we talk about financing this work, I offer that there's a real equation here in terms of calculating the forecasts of avoided losses, and the investment that will take to mitigate those losses. And I think that the return on investment here, which is always what the bottom line is for any investor, is what's the ROI of the investment? And I would suggest the ROI is both the avoided loss, it's also the property and casualty insurance reduction and premiums, as well as keeping some of these insurers in the marketplace. So one takeaway I hope you'll have today is the real challenge to try to help us identify what these returns on investment will be for not only mitigation, but the adaptation space. And so I'll say this, the way we're gonna solve climate resilience is multifold. 3 months ago, the Biden administration put out the first ever climate resilience framework to lift up this issue around climate resilience. And so the president understands that the federal government is putting incredible amounts of investment in cleaning up after disasters. We have a huge emergency management agency, FEMA. Has anyone heard of FEMA? That is solely dedicated to helping support management of disasters, but it's expensive and it's growing more expensive. And so in order to deal with the consequences of climate change, we have to have a different approach. And so I will pose to you, we need 3 different approaches. We need to think about policy, we need to think about capital solutions, and we need to think about the programmatic solutions themselves, the technical solutions. What would the equivalent be of the desal? What's the equivalent of what we were talking about before? And so we're not going to have time to get into those, but I will offer to you that we need the policy, capital, and solutions notion to be able to start to think about the multidisciplinary approach to this problem. So policy would be a stick or a carrot, and these are all intersectional. They all depend on one another to work. I think that in the solutions side of this, we need practitioner-informed solutions that are resilient, that we need to look at solutions such as nature-based solutions. We need to look at solutions that utilize data and future-facing data to help us understand how we're going to assess our risk. So Ilana had mentioned the physical asset market. I mean, that is a great place to start thinking about physical assets. How are we assessing risk? How are we mitigating that risk? How are we paying for it? And then how are we implementing it and executing? And so all of these aspects have to come into play. And the capital solution, I think, with the investment that the Biden administration has made with IRA and EJA and all of the different federal funding sources that are coming forward, this is a down payment, really, on a future where we will be more climate resilient. And this is an opportunity of a lifetime. We're at a true inflection point for the U.S. in terms of this investment. Our president is known as the climate president. And so I'll close with saying, how do we utilize the historic investment being made by this administration in climate risk and really lever it up? And I'm curious and want to talk a little bit about the carbon trading possibility. But again, we are at a place of great creativity, and so you're in a good space as students of this work to help us think through this. Thank you.
So maybe you can each ask questions from. Sorry, maybe you can each ask questions from each other, just one question, and we can open to the floor. If you don't have any questions, we open for questions from the audience.
They have many questions.
Can you talk a bit louder?
Hello. Hi, my name is Julian. So I wanted to ask about basically when legislation enables financial incentives, there's a lot of times when there's unintended side effects. Like with MBS, they really commoditized the housing market, right? But with ESG, what are your plans to prevent things like greenwashing? Or actually, could you give us a little bit more examples of greenwashing and other loopholes that may be exploited? Yeah.
Sure. So I'll give my perspective from the securitization or asset-based finance market. There are debt instruments called green, social, and sustainable bonds under the International Capital Markets Association, and they're use of proceeds bonds. So the company that's issuing the debt agrees that the funds are allocated to green, social, or sustainable projects, and they agree to do ongoing reporting, at least on an annual basis, about the impact of these green social projects. So in the ABS market, we have green auto securitizations, like I mentioned, that they're backed by hybrid and electric vehicles. So the issuers of these debt securities will, on an annual basis, disclose how much greenhouse gas emissions have been reduced because investors have invested in these securities instead of securities that are backed by internal combustion engines that are fueled by fossil fuels, for example. And normally when an issuer securitizes, or even if it's an unsecured debt offering, they get a second party opinion. So there's second parties like Sustainalytics, or some of the rating agencies or ESG rating agencies will provide an opinion and say these issuances or securities are in alignment with the International Capital Markets Association. So that's one avenue. Last year we saw in the securitization market $40 billion issued in green, social, and sustainable, but that was only a small portion of it, right? I said the mortgage market's like $10 trillion, so 2% about. Globally, across fixed income markets, we saw about $850 billion in green, social, and sustainable debt issuance across sovereign corporates and securitization instruments. So I think that's one avenue where you get enhanced data and disclosure from corporates or securitizations, and investors can quantify in some respect the outcomes that are being produced because of their investments, whether that's from, Lori looking at affordable housing, the GSEs or the government-sponsored enterprises, Fannie Mae and Freddie Mac, that help plumb the mortgage financing market. They're very proactive about this and providing equitable access to home ownership. They recently announced a new social bond framework for single-family mortgage-backed securities, and they're planning on providing going forward some of the benefits on home ownership for first-time home buyers or those that live in more unaffordable areas, low to moderate income housing, for example. So the more data that we get and then the more standardized it becomes, it's easier for investors to do a proper analysis without just slapping an ESG label on something and not really doing the work behind it.
Maybe I can add a couple. So I'll give you an example. Starbucks has a bond where the pledge is that they'll take the money and they'll buy fair trade coffee. So it's kind of like elementary corporate finance. If you borrow debt, you rarely use that to consume, So this is like the Starbucks' raw material is coffee. So this is like borrowing a 7 or 10-year debt instrument to pay for cost of production. You know what I mean? Cost of production. Starbucks is borrowing, not because Starbucks needs coffee. It's fair trade coffee. So the point here is not that Starbucks doesn't have the money to pay for coffee, which is the raw material. It's one unintended consequence. Because there is money available, people will basically raise money and do some strange things with it. The other issue is, let me ask you, right? Is Tesla a green company?
Probably not right now.
That's my point. So there's a huge labeling problem. So if you're buying an ESG fund, what are you buying? And how does the rating agency even know what is green? So one of the big issues in this space is, what are these ESG rating agencies doing? And people often conflate a credit rating agency with an ESG rating agency. Why? In the credit space, going back to the ABS world, there's a falsifiable question. Meaning, if you don't pay principal or interest, I know you're bad. In the ESG world, there is no falsifiable question. And if you don't have a falsifiable question, you get into the world of opinion and religion and whatever. And then nobody knows. So, this is an area where, as Elena rightly mentioned, it's like screaming for some kind of standardization. Maybe we'll never get that standardization. Maybe. The scope 1, scope 2, scope 3 problem. I can go on and on, but there's so many.
Eagerly awaiting the SEC's final climate rules.
Well, let me actually throw some cold water on that. So maybe we can talk later.
Any comments?
Well, I was just going to say, I'm just curious, the individual issues, though, right, of DEI or climate risk or, community engagement or other greenhouse gas emissions reduction, like some of those material issues can be measured and standardized, and there are companies and entities trying to do that. I think that the gestalt is the question.
No, it's a fair point. Then you run into the other problem. Now show me a link between all those things and future cash flows and risk. That's hard.
And I think the E and the S and the G don't always work in tandem. And even within the environmental component, you mentioned Tesla. Okay, they manufacture 100% electric vehicles, so we know we're reducing tailpipe emissions. However, the mining and minerals required to manufacture the batteries can have unintended negative consequences on the areas, biodiversity from which they're mined, social implications about who are these people that are mining it. Are they workers that are being protected? Probably not. And the Inflation Reduction Act does try and address some of these issues, but they're very complicated and they don't always work in the same direction.
Perhaps I can add something here briefly, that at this point is when people start getting confused about what are we talking about, what choices do we have, and what are the possibilities. And I wanted to clarify that the issue of what are we talking about and what are the possibilities for solution have been very clear now. They have been clarified. Climate change is the most serious risk facing humankind. They include the risk of survival. In fact, in the 6 incidents of extinction in the history of the planet, there have been 6 incidents of extinction. All of them, all 6, this is number 6, by the way, all 6 are caused by climate change. I'll repeat that. The knowledge is clear. This is the most important risk facing humankind, and it is a survival risk. There have been 6 largest incidents of extinction that include extinction of humans and in the history of the planet. And those 6 incidents, all of 6 are connected to climate change. Secondly, there appear to be many things that we can focus on in terms of solution, but that's not true. There are not many things that we can focus on. Of course, we can focus in anything we want, but in terms of a solution of climate change, there is only one solution that the Intergovernmental Panel of Climate Change, the National Academy of Sciences in the US, have published clarifying there is one solution, only one. Let me repeat that. The Intergovernmental Panel of Climate Change and the US Economy of Science have published reports saying that with respect to climate change, there is only one necessary solution. One. It's not whether we can use more solar power or anything like that. The solution is to remove the CO2 which is currently in the atmosphere. And they have provided the numbers of the tons of CO2 that must be removed. And that's a necessary condition. What that means is that either you remove, in this case, 550 gigatons of CO2 from the atmosphere, or you have no solution to climate change. So it has been greatly clarified. We cannot just think of electric cars. No, there are no choices. We have to remove the CO2 which is now in the atmosphere. According to whom? The International Association of All Scientists, that is the world recognized authority, the IPCC, and the National Academy of Sciences, which tends to be the leading scientific organization in the United States. Both of them have published reports saying what I just said. So what we're talking about here is neither voluntary, not one of the possibilities. It is the only thing that we can do, and if we do it, there is a solution to the problem. If we don't do it, there isn't. So it's all very simple in that sense. I think it's important to focus on that. Okay, I think this panel has done its job. And if there is any questions, I repeat, I am happy to provide, if you can circulate a piece of paper, and I can get the names and the emails of those of you who want the movie that I mentioned, which is only 20 minutes long, and it has a lot of the data that was mentioned here.
Also, I would just put a plug in. I put out a lot of administration announcements, et cetera, on my LinkedIn. So if you want any news about this work of adaptation, just
I didn't understand.
Yes, same here. Find me on LinkedIn or...
Yeah, feel free to add me as well.
She has to clarify? I cannot understand what you're saying.
They're just saying that find them on LinkedIn.
Yes, okay. So if all I'm saying is that if you provide to me a piece of paper with the names and the emails of the people who would like to see the movie that has a lot of data on what was discussed here, it's a short movie, about 20 minutes, I will be happy to provide it. Okay?
Yes, anyone could give their email to maybe one of our staff with the orange lanyard, and I will be sure to pass that to Professor Chichlinsky. Is that okay? Yeah.
Yes, that's fine.
Yes. I think our time is up for this
Okay.
panel. Thank you very much for all of our distinguished panelists. Thank you.